Second dedicated video on taxes, and in this video we're going to talk about capital gains tax. And what that means is if you purchase an asset, so an assets might include a house, or it could be a share, or it could be a painting that goes up in value. All of these are assets, and there are many others. And when an asset goes up in value, it appreciates and you hold on to it and then you sell it. The difference in the price that you sell it for to when you purchase it is called a capital gain, and you need to pay a tax on that. So to illustrate that with a graph, let's say I have a graph here, and this is the asset value, and this is time. And let's say that when I initially purchased it, it was worth $100. And then I held it until, let's say, 10 years later. I've had a very good run. This is 10 years. It's now worth $300. Okay, so the question to ask yourself is, well, how much has it gone up in value? This difference here is $200. So I've had a capital gain of $200. Now, where this links into tax is the year that you sell it. Let's say this is 2017. This needs to be added onto your income. And let's say you had an income of $80,000, let's say. One more zero, $80,000. And in the previous video, we talked about how to calculate taxes on that. Well, we need to now add on this $200. This will become $80,200, and then that, of course, increases the amount of tax to be paid. However, there is one catch to this. There is a rule in Australia whereby if you hold an asset for more than 1 year, which is the case here, the increase, you get a 50% discount on it. Now, there are a bunch of rules, technical rules around this, which I won't go into, but the general rule of thumb is if you hold an asset for more than 1 year, so 50%, I'm going to call this 50% discount. If you hold it for more than 1 year, you get a 50% discount on the capital gain. So in this case here, the example that I just gave, it's actually only going to be $80,100 because the capital gain was $200, but at a 50% discount, it becomes $100 is added onto your taxable income. Okay, so there are the key concepts there for capital gains tax. Let's have a look at this question. John purchased 100 shares in BHP for $25 per share. So the total amount invested will be the number of shares, 100, multiplied by the share price, 25, and that is going to be $2,500 invested in BHP. 5 years later, so it's more than the 1 year threshold for a 50% discount, the share price was $35 a share. So now the value is 100 multiplied by 35. So that will be 3,500. Let's have a look at the difference there. 3,500 to 2,500. It's gone up by $1,000. We'll come back to that. How much does John need to add to his taxable income the year that he sells his shares? So when John, third person. When John sells the shares, he will receive back $3,500 into his bank account. However, some of that needs to be taxed. This is the capital gain. However, so the capital gain is equal to $1,000. 50% discount will end up being $500. So the amount added to income for tax purposes will be $500. And that is the crux of capital gains tax. So just to recap, if an asset appreciates over time, the amount in which it goes up by needs to be considered for tax purposes. In Australia, if you hold that for more than 1 year, you get to take a 50% discount on that increased amount and it's added to your income. Now, like I said, there are a bunch of other stuff about this. You can also deduct losses and and there are only certain types of assets that get the 50% discount. But the big picture here is capital gains tax is capital gains are added to your taxable income, and you are eligible for discounts if you are eligible. Okay, and in the next video, we're going to talk about dividend franking credits, and then we're going to move on to our assessment piece.